In part two of this series of video clips about currency exchange, we take a closer look at what can change the value of a currency, i.e., what can change its price in the global exchange market. You'll recall in our first clip we talked about currency as having a simple demand and supply curve. Demand for dollars and a supply for dollars in this case, or pick any currency that you want. And changes in the price, in this case paying British pounds for dollars, could cause movement along the demand curve or movement along the supply curve. But what we also want to talk about is what can cause a shift in demand or a shift in supply. Let's look at the supply side first. In addition to a change in price, what would cause movement along the supply curve, there are other items or forces that can cause a shift in the supply curve. For instance, the central bank for that currency's country, in the case of the United States, the central bank is the Federal Reserve, can exercise monetary policy which will either increase or decrease the supply of money. Now, in the case of the US dollar, that increase and decrease in supply doesn't have a huge or significant impact on the supply curve, given that there's so many dollars in circulation throughout the world. But in theory it can. So the Federal Reserve or the central bank of any country can affect the supply of dollars in circulation through their exercise of monetary policy. In addition, in the last several decades, there has been increasing activity in international currency exchange as an investment vehicle. Investors buy and sell currencies, hoping for the value to change in the short run so that they can buy low and sell high. Currency speculation, again, doesn't have a huge impact on the value of the US dollar, given the size of how many dollars are in circulation. But for many other smaller countries, this currency speculation can have a major impact, and in fact, in decades past, have threatened currencies even as large as the Brazilian real or the Mexican peso. So those are just two examples of what can cause a shift in supply one way or the other. On the demand curve, we talked about in our first clip about how exports can change the value of the currency. The example we had earlier showed an export from the United States to Scotland, and that process, magnified hundreds and thousands of times, can cause an increase in the demand for dollars, which is a shift in demand to the right, and that would then raise the value of a dollar in the marketplace. The other thing that can cause the dollar or another currency to go up is increased foreign investment. As more foreign investors bring their money into the United States, they are in essence exchanging their local currency for dollars, just as if they were going to buy an export item like the cheese. So when somebody from Switzerland or Russia or China buys or invests in something in the United States, whether it's stock or real estate or whatever, they're converting their currency into dollars, and that in turn increases the value of the dollar in the marketplace. The other thing that can shift demand are more psychological factors, concerns or fears about the country's stability. And investors, especially foreign investors, are less likely to bring their money into a country if they fear that the country's going to be unstable or that the value of the currency is hard to predict. That adds a risk to that investment. So countries that are going through lots of changes, political turmoil, and so on, are less likely to attract foreign investment, and thus that would push the value of their currency down. The United States, for all the concerns we have internally or domestically, is still seen as a very safe haven for investments, and we saw in particular during the most recent recession that for a while the value of the dollar increased because there was a flight to safety. Basically, foreign investment monies were coming to the United States as one of the few remaining places in the world that they had some confidence in. The other thing that can change the value of a currency is interest rates in a country. If one country has interest rates that are higher than the other countries, then that will attract more foreign investment. If something's going on so that the interest rates on loans and so on, savings accounts are higher in, let's say, the United States, then that'll attract investors from overseas who want to enjoy those higher returns. That too then increases foreign investment and increases the size of the dollar. In our next clip, we're going to talk about just a couple of policy issues that swirl around this area of currency exchange.